The market is heading toward a 2026 volatility wall, and your common stock dividends are sitting directly in the line of fire. Emotional attachment to traditional blue chips is blinding most retail investors to a massive structural risk that is building quietly underneath the headline numbers. While everyone else is hoping for capital appreciation and waiting for dividend growth that may not come, there is a mathematical case for a completely different approach. One built on contractual income rather than corporate goodwill, on priority claims rather than residual payouts, and on cold arithmetic rather than brand loyalty. This video is that case, the mathematical case for priority shares over common dividends in 2026. By the end of this video, you will understand exactly why the assumptions that made common stock dividend investing reliable for decades have quietly shifted. What corporate treasury behavior is actually telling you right now about the future of common payouts, and why the structural safety of priority income deserves serious attention from every income investor who has been sleepwalking through a market that has fundamentally changed. If you want honest mathematical analysis on income investing in 2026, hit subscribe. I post this every single week, and this is exactly the environment where getting the math right matters most. And before we go any further, quick question for the comments. Do you currently hold any priority shares or preferred equity in your portfolio alongside your common dividend positions? Or is your income strategy built entirely around common stock dividends? Drop your answer below. I reply to every single comment, and your positioning right now shapes which part of this video is most relevant to you. Let us start with the post-growth reality of 2026, because this is the foundational context that most income investors are not fully processing. For the better part of 3 decades, the dominant narrative in retail investing was straightforward. Buy quality common stocks, reinvest the dividends. Let capital appreciation and dividend growth compound together over time. The businesses keep growing, the payouts keep rising, the portfolio value keeps climbing. Patience is rewarded. That narrative was not wrong for a long time. It worked because the conditions that supported it were real. Interest rates were structurally low, making equity income attractive by comparison. Corporate earnings grew consistently. The technology sector in particular delivered the kind of multi-year growth trajectories that made capital appreciation feel almost automatic for anyone who owned the right names. The wealth was real. The strategy worked. But here is what has changed in 2026 that most retail dividend investors have not fully incorporated into their thinking. The era of reliable common stock growth projections is over, not temporarily paused, structurally over for a generation of retail investors who built their models on assumptions that no longer hold. Market volatility is no longer an occasional disruption to an otherwise upward trend. It is the baseline condition. The volatility wall approaching in 2026 is not a single event you can time and avoid. It is the persistent operating environment, geopolitical fragmentation, interest rate uncertainty, AI-driven labor market disruption, deglobalization pressures, commercial real estate stress, and a consumer that is genuinely stretched in ways that do not show up clearly in the top-line data until they suddenly do all at once. In this environment, the capital appreciation component of common stock returns, historically the larger portion of total return for most equity investors, becomes genuinely unreliable as a planning assumption. You can still get it, but you cannot count on it. And income investors who built their retirement projections around getting both the dividend and the appreciation are now running models that only reliably deliver one of the 2 inputs they assume. Now look at what the largest corporations are actually doing with their cash. This is where the mathematics starts to get uncomfortable for common dividend investors. The major technology companies, the ones that have driven the majority of S&P 500 returns for the past decade, are not increasing common payouts at the rate their cash generation would theoretically support. Microsoft holds hundreds of billions in cash and equivalents. Apple has been running the most aggressive buyback program in corporate history. Google parent Alphabet has been accumulating cash reserves at a pace that far exceeds its dividend growth commitments to common shareholders. The explanation for management is always the same: capital allocation flexibility, investment in AI infrastructure, strategic optionality in a rapidly changing environment. Here is what that actually means for common shareholders. The corporations themselves are uncertain about their own forward projections. When a company with $200 billion in cash pays a 0.5% dividend yield, it is not because management forgot that shareholders exist. It is because management has made a deliberate calculation that retaining that capital gives them more strategic optionality than distributing it. And in a volatile, rapidly evolving environment, that calculation is rational from their perspective. But it leaves the common shareholder in a fundamentally uncertain position. You are relying on a company's ongoing willingness to continue paying and growing a dividend that is discretionary by nature. In an environment where the company's own projections are uncertain, where capital retention is being prioritized over distribution growth, and where the equity market is pricing in assumptions about future earnings that have a much wider range of outcomes than they did 5 years ago. The common dividend is a residual claim. After the company pays its employees, its debt service, its taxes, its capital expenditure requirements, and retains whatever management decides is appropriate for strategic purposes, what is left gets distributed to common shareholders. In good times, that residual is generous. In volatile times, that residual is the first thing that gets compressed when earnings disappoint or capital needs spike. This is the structural risk that emotional attachment to familiar blue-chip names prevents most investors from seeing clearly. You know the brand, you trust the management. You have owned it for years and it has never let you down. That familiarity is not analysis, it is attachment. And in 2026, the mathematical reality of what you actually own as a common shareholder deserves a cold-eyed reassessment. Now contrast that with the structural position of a priority shareholder. Priority shares, preferred equity in its various forms, sit higher in the capital structure than common equity. When a corporation distributes income, preferred shareholders receive their contractually specified payment before common shareholders receive anything. When a corporation faces financial stress and must make choices about capital allocation, the preferred dividend obligation comes before the common dividend in the priority queue. This is not a minor distinction. It is a fundamental difference in legal and contractual standing that has direct mathematical implications for income reliability. The preferred dividend is not discretionary in the same way a common dividend is. In most structures, if the preferred dividend is not paid, it accumulates. The company owes it and cannot pay common shareholders until the accumulated preferred obligation is made whole. This creates a contractual floor under the income stream that simply does not exist for common shareholders. The mathematics of this structural advantage become particularly visible in stress scenarios. When a company cuts its common dividend, something that has happened repeatedly across industries during every major market disruption, preferred dividends have historically been far more resilient. The common shareholder absorbs the cut. The preferred shareholder is protected by contractual priority. In the current environment where corporate earnings visibility is reduced, where capital retention is being prioritized over distribution growth, and where the volatility wall of 2026 creates genuine uncertainty about which companies will maintain common payouts and which will not, the mathematical case for shifting income allocation toward priority structures is not a niche contrarian position. It is a logical response to what the data is actually showing. The yield environment supports this shift as well. Investment-grade preferred securities from well-capitalized issuers currently yield in the 5 to 7% range. That is comparable to or better than the yields available from most common dividend stocks after accounting for the fact that common dividend growth has slowed meaningfully across the corporate landscape. You are not giving up income to get the structural protection. You are getting paid comparably while moving up the capital structure. The objection most common dividend investors raise at this point is dividend growth. Common dividends grow over time. Preferred dividends are typically fixed. Over a long enough time horizon, the growing common dividend compounds into significantly more income than the fixed preferred payment. That objection is mathematically correct under one critical assumption: that the common dividend actually keeps growing. In a stable, low volatility environment with consistent earnings growth, that assumption is reasonable. In 2026's actual environment of elevated volatility, compressed earnings visibility, and corporate cash hoarding behavior, that assumption deserves far more scrutiny than most income investors are giving it. A fixed preferred payment that arrives reliably every quarter for the next 10 years is mathematically superior to a growing common dividend that has a meaningful probability of being cut or frozen during the volatility events that 2026 is likely to generate. The growth optionality of common equity only has value if the growth materializes. The contractual certainty of priority income has value precisely when growth does not. This is not a case for eliminating common dividend positions entirely. The highest quality dividend aristocrats with 40 and 50-year growth streaks, investment-grade credit, and payout ratios well below earnings will almost certainly maintain and grow their distributions through whatever 2026 delivers. Those positions belong in the portfolio. But the mathematical case for the allocation between common and priority income deserves a serious reconsideration in light of what the current environment is actually showing about corporate behavior, earnings reliability, and the distribution of probable outcomes for common payouts. Cold math points toward increasing priority income exposure at this specific moment in the market cycle, not as a permanent philosophical position, but as a rational response to the structural realities of 2026. Now, the question I want from you before you go: do you currently have any preferred equity or priority share exposure in your income portfolio? And if so, what percentage of your total income allocation does it represent? If you have none at all, what has kept you from adding it? Drop your honest answer in the comments. I reply to every single one. Hit subscribe for weekly honest income strategy content. Let us build something built on math rather than hope.